All right. Welcome back to the Educated Homebuyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. Back this week, Mr. Josh Lewis, certified mortgage consultant, expert, all things. Welcome back to the show, Josh.
I thought you were going to say all things fantasy football, but that's a different show.
Yeah, and I wouldn't really go there. I'm not sure how many you've won. We don't know your record. We can't say expert there, but what I'd like to do tonight a little bit differently, we did this in the past, is ask everybody where they're watching from. Gives us a really good idea as to, who's out there, right? We want to know where you're listening from. So put that in the chat if you don't mind. We'll say hi to you for one, but it's also good to get an idea of where people are viewing from. And then also let us know what your biggest fear in the market is. What are you concerned with right now in the market? Is it crashing? Is it a moderation in prices? Is it affordability? Maybe it's all of them. Maybe it's nothing. Maybe you just solid, rock solid. You have no fear at all. So let us know in the chat how you feel about that. And Josh, last week you missed inflation, right? You were out golfing. We were all missing you.
I wish I was here.
We
The
were
way
envious.
I was golfing, I was missing you guys. Let's say that.
We were envious of what you were doing. Okay, that's fair. And that was really it. But you were out golfing. We were here talking about inflation numbers. So inflation numbers actually improved a bit from where they thought they would. With that, we saw, not immediately, but over the next day or so, we saw rates come down, which was a positive thing. And then we've got the job numbers, right? The job numbers came out and were actually quite a bit higher than expected, and rates went up. So where do we sit today with rates, and what do we look like at the moment?
Kind of the worst we've been in a couple of weeks, but it's a fairly narrow range. We had we've showed you guys the charts before, and we had a pennant formation where lower highs and higher lows keep coming together and telling us we're going to break out one way or the other. We didn't really break out today because below that pennant we had a couple layers of support. So still in the same range. Best borrowers for conventional loans are going to be in the low fives. Best borrowers on an FHA, VA, USDA loan going to be mid to mid high fours from that range. And we're still seeing a really weird rate sheet. We've talked in the past, Jeb, you and I are both firm believers. Do a 0-point loan. Don't pay a bunch of upfront costs for your loans. But the way lenders have been pricing, the way the bond pools are pricing, there's a pretty big incentive to pay a point right now. For the most part, if you pay a point, you're going to get about a 0.5% better rate than 0 points. So that break even is just a little bit more than 2 years. And in a normal market, the rule of thumb is you get about a 0.25% improvement for that 1 point. And that break even is out almost all the way to 5+ years. So some weird stuff. You want to make sure that the lender you're working with is on their toes, is looking at that rate sheet and helping you analyze what's the sweet spot for lowest cost, lowest rate combination between the two.
Good stuff. And Friday, I'm going to just kind of throw this out there now. Video that I recorded on not shopping lenders. We already talked about switching lenders, right? I've got a couple of people reaching out recently saying, hey, can I switch lenders? Rates have gone down, or I'm approved with a builder. I don't want to move forward with that lender anymore. So Friday, going to talk about that in a little bit more detail. So check out that video. And then also we missed last week with regards to the Educated Homebuyer podcast. Both Josh and I were, our schedules didn't work out. So we are back. We actually posted a new podcast today where we address the second part of commonly asked questions, primarily dealing with employment questions for the better part of the podcast, but an in-depth review of that. So check that out on the educatedhomebuyer.com or Edubit. You could go to the educatedhomebuyer.com, but you could check it out on a podcast platform, whatever you listen to. And then this will be streamed on that same podcast on Friday, the entire episode. So if you can't listen tonight, you can listen then. So Josh, before we dive into some more housing market stuff, we've got people watching from all over the place. Napa, San Jose, Palmdale, Fallbrook, LA, Fresno, a lot of California. Aren't you people supposed to be at work? It's 5:00. What are we doing here? Early leavers in here in California. New York City, Let's
Boston.
see.
We got a Boston here. Boston and New York City
Boston.
can duke it out. We can have a
Boston.
Yanks Red Sox fight, Knicks Celtics. Any way we want to go with that.
Michigan, Orford, Oregon. Port Orford, Oregon. Say that 3 times fast. Let's see. San Jose, Orange County here where I am. Like you said, Boston. Got a lot of people saying hello. El Dorado Hills, South Florida. So a lot of different places, but a lot of people here in California. Every week I talk about inventory. Inventory is important because it kind of gives you a direction that the market's headed. Now, you can look at inventory a couple of different ways. I'm going to ask that you look at it like this, just because I think it makes the most sense. So today here, before coming on the show, we had 4,016 properties here in Orange County as active listings on the market. Now, if you remember, last week we were sitting about 4,060 properties. The week before that, about 4,040. Before that, 4,040, somewhere in there. So for the last 4 weeks, right, that's a month, we've been sitting in the mid 4,000, between 4,000 and 4,100. Today, we're at the lowest level we've seen on that number in probably a month and a half. Now, why that's important is because I think it shows that we're reaching a peak, at least here locally, in what we're going to see in inventory this year. Maybe I'm wrong. Can inventory go up from here? Sure, it can. But I think seasonality, kids are going back to school, right? A lot of schools just started. A lot of, schools are going to be starting if they haven't already within the next couple of weeks. That's the seasonal slowdown in the market. Now, sometimes right after summer, you get a little bit of push in buyer demand and inventory goes down even further. I don't know that we're going to see that. But what we are going to see is inventory. We're not seeing these 100 properties every single week come on the market when I do this show. We're not going from 4,000 to 4,100 to 42 to 43 each week. So I think that's important because, inventory is a key driver, of the future of the real estate market. So, Josh, outside of that, mortgage applications, no surprise there, declined a little bit, right? Refinances obviously are getting, pretty much non-existent for the better part of those mortgage applications. But what are we looking at right now? What can rile the market? Like if I'm a buyer out there and I'm looking at all the headlines and all of this stuff, should I be worried about pending home sales numbers, which are getting ready to come out, them just getting hammered, or existing home sales getting hammered, right? It's lagging data for the most part. Is it concerning? What do you feel like is important at the moment?
It's all important, and it's important to watch it. And it's not alarming in the short run. It's amazing to me how quickly people forgot how alarming it was, how rapidly things were going up, and how, despite the fact that we've added a bunch of inventory, we still have historically low inventory levels. I had a conversation with a borrower today. They qualify. Go through the numbers. No one loves the numbers right now with prices up, interest rates up. And the big question was, well, is this a crazy thing to do? Are home prices going to crash? And that's the thought, and that's the mindset. Is a crash a possibility? Always a possibility. It would require some type of black swan from here going forward to get us there. Something that we aren't seeing or foreseeing right now. Because what we do foresee, the possible range of outcomes is maybe a 10% correction to slow to no growth for the next 3 to 5 years. We've talked about this on the show. There needs to be a correction. A correction does not have to come in the form of a decrease in home prices. It can come in an extended period of flat prices. And flat doesn't mean zero. It could be 1%, 2%. Historically, we see about 4.5% return. When we look at all of these numbers and averages are mean reverting. We just had 2 monster years of appreciation. Looking forward, it would be reasonable to expect that we would have less than normal appreciation. The things that will get us back to homes appreciating at a normal level would be getting affordability in line. Affordability comes in line by home prices decreasing. So there's one method of that happening. It comes about by incomes increasing, which they do, even though no, they don't increase at the rate anyone would like, and we'd all like people's wages to go up faster. And then we also have interest rates can go up or down. Going forward, I do still believe the future is deflationary, and that will lead to lower interest rates. So that will be supportive of home prices. Wages will go up, but not at the rate that we think. And I think we're headed more for a sideways trend. So people looking at thinking that home buying is get rich quick, like it was the last couple of years, I think those people are going to be disappointed. You and I have talked a million times, for the people that it's the right point in their life to own a home, it's going to be a good investment going forward. And I have very little concern about a crash. And for us to even see, Jeb, why don't we talk about what would it take for there to be a 10% correction? I mean, one of the questions we saw here earlier, I think I started here. Someone asked 6 weeks ago, Kevin says, you were saying prices wouldn't decline significantly. Have you changed your mind? So a couple things, Jeb. What would you call a significant decline at the current prices? To me, anything more than 3 to 5% is significant. I wouldn't call it huge, but to me, 10% would be truly significant, and I think that's probably a maximum that we would see. And I'll tell you why I think that. But what do you think would be a significant
I
decline?
mean, the fact that we've seen house prices go up nearly 40% in 2 years, to give 10% back, I mean, that would be a significant move. I don't know that I would be like crazy even concerned if prices pulled back 10%. I mean, if you bought, a $1.2 million house and now it's worth, 1.1 ish, I don't know. I that doesn't necessarily concern me as long as you're in it for the right reasons. Now, yeah, so I would say 10% is probably my number. So I don't think it can go more than 10, quite frankly. But who
Or
am
you
I?
would say it could, but it would require something that we're not foreseeing right now, something far more than a recession.
It requires distressed property and a significant amount of it, in my opinion. Nothing else matters, quite
Yep.
frankly.
And
I
how
don't.
do
I
you
mean,
get it? How do you get a volume of distressed properties in the current market?
people have to let go of their properties. They have to not pay their bills. They have to go through the foreclosure process and just say, screw it, I'm staying in here. And then that turns into a foreclosure, which ends up going on the market. That's,
Which
yeah.
there is all, you wouldn't say. So you have to look at your area, look at median prices, and let's say, what's Orange County now, Jeb? Is it over 900?
I, I think it's pretty close to $1
It's
million.
it's an absurd number, whatever it is. So if you bought 2 years ago, you probably paid $700,000 for that property. So you're close to $1 million. If that thing drops 900, you're still sitting on $180,000 of equity. You're not going to let that go to foreclosure.
Detached Huntington Beach. I mean, I'm sorry, Orange County median sales price in July of 2022 is $1,255,000.
I was only $350,000 off, and I'm the
Yeah,
numbers guy.
for
You
for
like
an
that?
attached property, the median in July is 680,000. So a condo. Yeah,
So everything in there, it's probably $1 million-ish, something like that.
yeah.
But long way of saying, now if you go to sell that, you have 5 to 6% selling costs.
Mhm.
So $1.2 million property, that's $60,000. Property value comes down $100,000. The only people who would be in a situation where there would be a foreclosure or a decision to post up in that house for a year or two, holding off a foreclosure sale, are people that bought in the last year and paid too much on the wrong property. So are we saying there's none of those people out there? There probably are, but the vast majority of people bought 5 years ago. Jeb, you
But but
brought up the video from 2015,
but
7 years ago, and you were talking about numbers. What were we saying? A median price in Huntington was 700 at that time.
yeah, yeah. I mean, I'll get into that in a second. But you said something that I don't feel like is fair, because you said, if they bought in the last year, then those would be the people that. But those people also have to have shelter, Josh. right? So what are they going to do? They're going to go rent
I'm not
something.
saying those people are going to do that.
No,
I'm saying
I'm
those
just
are
saying,
the only people who
but
would
their
be at
option
risk
is
of
to
that.
let it go. Their option is to stay in it and continue paying, figure out what the situation is, long-term plan, whatever, or let it go and then have to go rent something. And they're going to be in the same position either way. You either own a house and you have the benefits of owning that property, and maybe you're, at what you paid for it, maybe a little bit lower if that even happens, and or you got to go rent for something probably less than what you have now if you're trying to save money. So
Yeah.
in my experience, people aren't willing to do that.
And what is different? So people want to know, a lot of our buyers, first time buyers, are early 30s. Say you're 35. 2008 was
Ooh,
now
35. That was a good year.
was what, 14 years ago? A 35-year-old was 21. When I was 21, I was just getting into the mortgage business, and that was when I started looking at home prices, interest rates, appreciation, all that stuff. Most 21-year-olds aren't paying any attention to that whatsoever. So our buyers, they have that frame of reference. They remember friends, family members, parents that lost homes, so they think that that's normal. So let's use an example. The very first house I flipped, we bought in October of 2008. We paid $265 for it. The gentleman, we found out when we went, because we bought it, it was a trustee sale, so we had to go and get him out of the property because he was still in it. And he tells us, no way, I've got a lawyer, he's going to fight this. And I said, well, it's not how it works. Here's the deed. I actually own the property. There's no more fighting. But I said, more importantly, let's just talk about why you would fight. How much do you owe on this property? He goes, 100% financing. I paid $685 with all the penalties and everything. I owe a little over $700,000. So we just bought it for $265, and he owes over 700,000 on it. And that's still not necessarily registering with him. I said, if you had the greatest lawyer in the world and he could get $400,000 knocked off of that, you're still $100,000 upside down. I said, more importantly, look at your house. I'm not being mean, but how great a condition is this house? It's not great. It's been deferred maintenance, needs a ton of work. I said, okay, your neighbor across the street, you see his house? Is that nicer than yours? Yeah, it's a lot nicer than mine. Okay, cool. What is your payment? His payment with because it was a 228. It was a hybrid arm that basically a teaser rate for 2 years. So after the 2 years, it went from, he had like a 6.5 rate, and it went to like 11%. So his payment was $6,000 or $7,000. I said, okay, so you're $500,000 upside down, and your payment is $6,000 or $7,000 a month. How much could you think you could rent that nice house across the street? He goes, I'm not sure. It's about $2,200. So I said, so you're telling me you want to stay here and fight for a house that's $500,000 underwater to pay $4,000 too much a month when you could rent a nicer one for $2,200? And lots of people looked at that and made the same decision. I didn't put any money down, so I don't have money tied up in this. I can rent much cheaper. So Jeb, what you were just saying is rent's not a lot cheaper unless you get a much different, cheaper, smaller property,
You
an
got to get a
apartment.
different property.
You got to go to a different property level before you're going to get that big savings. So people are going to fight, scratch, and claw to stay in their homes. And one of the reasons why we're not seeing inventory increase is we had a flurry of people who really wanted to sell, and they saw that window closing and threw homes on the market. Now the people who were interested in selling are probably going to just stay put. So we could see, you're asking what numbers do I look at, Jeb? What are we looking at? I look at sales volume. I expect sales volume to decrease because there's less demand at current affordability levels, and there's less homes coming on the market because people would rather post up. So to see a correction, to see a significant decline in home prices, you have to have a bunch of those people say, I can't afford this. I'm willing to sell at whatever price and live in something less than what I live in now because my payment's going to be a lot more to rent. Most people are not going to make that decision. Some people are going to be in bad financial situations. So where does it have to go? The economy has to get so bad that no one can afford their houses. And that was not the situation in 2008. In 2008, unemployment got up over 10%, but that was really concentrated in the lower income levels. I'm not saying only lower income non-homeowner renter households suffered job losses. Lots of people did, but it was concentrated in those levels. So we're going to have less job losses. So even if we got back to that level, which no one is projecting at this point, we have an issue of part of the reason why the future is deflationary is that we have a declining population. The way you get inflation and growth of an economy is
decelerating population.
Decelerating. Yes.
Not declining. So, I mean, like we're not having any less people on Earth. We're just not growing at the rate
that we were. Is lower.
Correct.
So
and I think that's important though, because there is a distinction, and people are like, well, there's nobody being born, and like You know, there's not going to be people to buy these. Listen, there's just less people being born. Yeah.
Absolutely. So when we look at that and you say, why is that deflationary going forward? Why does that lead to lower interest rates, which is supportive of higher home prices, especially in areas where land is scarce, like Southern California, Bay Area, New York City, those types of areas, is that growth and inflation comes from an increasing population that has higher levels of productivity. I don't know if you've been looking at productivity numbers. We just had a 40-year low in productivity. Population is growing at the slowest rate in the last 50 years. So those things tell us that there are less people available in the workforce. So an able-bodied, good employee should have a job in the next few years going forward. I'm not saying that anyone out of a job is a bad person or not a good employee, but most educated, hardworking, diligent, skilled people are going to be able to keep their jobs. I just don't see a recipe for widespread unemployment where people have no choice but to sell their home, because that's where we're at right now. People
1,000%.
given a choice will stay in their home.
1,000%. And that's, you said something really important there. People that want to have a job will have an opportunity to have a job. I was just back in North Carolina. If anybody, you guys heard me talk about it, I'm from a rural town, Eastern North Carolina. Population's 20,000 or so, but mostly farmland, country, you know, middle of nowhere. I saw a sign. They were hiring bus drivers, a school bus driver. Guess what they were paying the school bus driver, Josh? $17.50 an hour. That's if you worked full-time as a school bus driver. Granted, it's only a couple hours a day, in the morning, the afternoon. Remember, you got to drive through the country, so it's not like a 30-minute, bus drive. This is like a couple hours in the morning. You're probably making pretty good money in that area because of the cost of living there. So, again, I'm not saying this is a great job, but it's an opportunity. If somebody doesn't have another option, there is an option to have, employment. And that doesn't just mean out there. That's everywhere. There's signs everywhere. Like, we keep going to restaurants where the service sucks, and we get in there and the staff's like, nobody comes to work. We can't get anybody in here. We can't get good people to show up to their job. Like, what? Like, when do people just not decide that they don't want to work anymore? Like, this is, but anyway.
And it would, what we see is those lower level entry jobs. It would be naive to think that doesn't happen in higher paid jobs as well. But Jeb, we're having a good discussion. There's a good discussion going on here in the comments.
Well, but yeah, that's the one I wanted to click on. So there's something called market psychology, right? It is the idea, the emotion. It happens in stocks, it happens in housing, it happens in everything. And what's important here is, we've talked about it, Josh, off camera and even on camera, is that, occasionally, people buy a stock at a certain price, right? Let's just say it's $50 for our conversation here. That stock price goes down. Let's just say it goes down 50%, goes to $25. Most people end up holding that stock and never taking the loss. It's a paper loss, right? Because it actually hasn't happened, because they don't want to cope with the fact that they've lost money on paper. So what happens? They hold on to it until the price comes back up, at which point it hits what they paid for. A lot of times people will sell. They'll get out because, yeah, God, it got back to my price, I'm out. And then guess what happens? Continues to go up. That's what happens. Same thing with housing prices. They are sticky to the upside. People aren't going to sell their house because their neighbor sold their house for, $10,000 less, and now they're panicking and they got to get out just because the neighbor's house went down. There's a lot more that goes into it. And on top of that, Josh, we talked about it, transaction cost. It's a lot more expensive to sell a piece of property, selling it and buying something else, or selling it and going to rent something else, than it is to sell a stock, right? You can go on right now and sell a stock probably for nothing versus what it costs to sell a house.
And then the replacement cost as a rental, or so two pieces. Alex Rodoni followed up here and says, give up 20 to 30% if they sell, but that would be silly, because if you're going to replace it to buy, you're giving up a 3% or sub 3% interest rate for a 5 to 6%.
We've trained these people well, Josh. They just come in with the comments.
Just have the right answers. That's really what it is. If you want to be a homeowner, it makes sense to stay where you're at. Now, if homes drop 20% across the board and you have an $800,000 house that's now worth $640, and you want to buy what used to be a $2 million house for 1.6, well, cool. The gap just got smaller, but the rate's much higher, and very few people make those types of jumps. So the comment was a huge drop is possible. Of course, a huge drop is possible. It's happened before. 2008 happened, but we just laid out all the reasons why that happened. It was logical and rational. You say the pain of leaving my house is far less than paying 1/3 less for rent for twice as nice a house, which is not an option. Now the pain of leaving my house, like I'm giving up my awesome interest rate. I'm giving up the principal portion of my payment every month. I'm giving up the autonomy of owning my home and doing whatever I want here. And I'm subject to a landlord who can not renew my lease, who can not lease to me at all. One of the guys I talked to today is like, we're out here trying to lease a property. My wife says, this is stupid. We should buy. It's easier to get a property under contract than it is to get something to lease. The rental market is more nuts than the housing market right now. They were both nuts a year ago. The rental market has stayed nuts. So no one's sitting here telling you that home prices cannot go down. I'm telling you the million reasons why the deck is stacked against a decrease of any significant portion of the recent gains. We are more likely to trade sideways. I wouldn't buy today expecting a huge return or a big gain on my money. If I'm investing in real estate today, the play is to go out and get a discount on a property. We can have a conversation for a different day. If you're a first-time buyer watching this, very unlikely that you're going to be able to go and get a discount on a property, because to do that, it has to be off market. We talk about market efficiency. Real estate markets are pretty darn efficient. It used to be that realtors had access to the multiple listing book that was published once a month, and they kind of controlled that, and it was hard to get that information. Now Zillow, Redfin, everyone has it published everywhere. If you have a house for sale, people are aware of it. So it's just the market is priced accurately where it should be. And people don't like that. And there's reasons why people won't back out of the market and are more likely to just stay put for an extended period of time. So where I was going with the efficient market, you have to get someone who is not tuned into that efficient market, a seller who just wants out. They're so distressed, or they're so unaware, or so time sensitive that they'll sell to you at a discount.
But
If you're
is it
working
that
with
the entire world right now, Josh?
Apparently not, because we're not
Man,
seeing home prices come down. I mean, the
weird.
best example, Jeb, I thought we had a deal for certain. I was going to have a purchase contract coming in. Great conversation with the listing agent yesterday. Awesome borrowers, incredibly well qualified. We did a cross qualification with the other lender. He's like, I'm rooting for you guys. VA offer. I always want veterans to get this home. We were the highest offer. Borrowers increased their offer $20,000 so that they were above the other offer. Guess what comes in this morning? Another offer $50,000 above that. But then you show up online and people are talking about market's going to crash. No one wants homes. No one can pay these prices. But I see it every day. None of my clients are running out and just making whatever offer they want. I'm not saying that's not happening in parts of the country, but for us, in all of the markets that I'm aware of in California, I have yet to have a client come say, hey, get me pre-approved. I'm going to go out and just write 5 lowball offers and see which one I can get, because it's not the market we're in.
And in fact, like, just to go on this, and we'll get to some questions here in a second. I did a live stream today, not a live stream, sorry, a collaboration with Melanie. She's in Tampa Bay. She has a YouTube channel, and also I'm drawing a blank. Oh boy,
Don't draw a blank. That's offensive.
It'll come to me in a second. He's in Dallas, and both of them. We talked about new construction. New construction is a big part of both of their markets, and I asked the question. I said, hey, listen, is what we are seeing out there headlines like reality? Are we seeing big price cuts on new construction in your markets? And the answer was no. You're not seeing big price cuts, but what you are seeing is incentives to the agents to bring in buyers, right? And partly there was none of that for 2 years. New construction companies didn't have to work with buyers agents, because guess what? They held the jewel that everybody wanted, right? Which was a house. And therefore they didn't have to cooperate. Well, now they do. And on top of that, they have to deal with rising rates. And keeping buyers under contract. And so I asked the question, what's happening? Well, they're incentivizing us to bring in people. And a lot of these builders are buying down the buyers' interest rates to keep them under contract. So they're giving them discount points. They're doing things to make the payment more affordable. Melanie in Tampa said none of her buyers are backing out. We also had the conversation about, okay, so these communities, because both of them are big with home builders, because we see the new construction numbers, right? And it looks overwhelming with the amount of properties that are still being built, right? A very small percentage of them are actually completed. the larger majority are under construction, and then you also have some that where permits are pulled or whatever, and they're not under construction at all, and likely won't be. But that large majority of properties that have started construction, I said, what happens on those? Are those spec builds? Are those people that went under contract, builders that built homes because they already had buyers under contract? And it's that. A lot of these properties are being built with buyers under contract. Now, yes, there are some buyers backing out. In fact, I had a slide here that I can throw up on the screen in just a minute after I'm talking of where these buyers are backing out in different states or what have you. And it shows the percentage. And believe it or not, guys, even last year, a percentage of people were backing out of contracts. Now, I'm not discounting the fact that the numbers are higher, and there's a reason, right? Affordability is obviously a play on that. But it's, people say, well, foreclosures are increasing. Okay. Foreclosures have been a part of the market for 50 years. Like, there's no surprise here. Like, it's just used as a headline to make a story and to create a narrative. So anyway, enough about that. So let's go on a positive note. Nap Terrell, possibly.
I believe so.
Bought a house in January this year, 32 years old. So congrats to you. That's awesome. Let's see here. We got Phil selling his condo next month in Fountain Valley. Would love to talk to you, Phil. Reach out, bro. Dennis saying best team in YouTube. Good stuff. Josh, we're going to start with really basic question. Mr. Abs. I like that better than ABS. I don't know. I'm going to go with Abs. What are some of the common reasons why so many homes are going back on the market? Usually say at no fault of seller, saw a home that had been pending since last July 21st go back on the market. So Josh, what are your thoughts when you see a home going back? In your experience, let's just not even take the market that we're in at the moment. Say, let's go back 5 years. If a home was back on the market, what happened? Why?
Generally a problem with the property that the buyer wasn't aware of or thought they would be okay with, and they get 10 days in, they're still in their contingency period, and they're like, no, I don't like that school district, or I don't like that there's a 7-Eleven that I can see out of the corner of my eye, things of that sort. So those were the most common things that I saw. But Jeb, kind of the things I wanted to point out, you talked about foreclosures increasing. Well, but from what level? A very high percentage increase, but from what level? So he's asking, why are we seeing so many homes go back on the market? I don't know that it's more than normal. I would say the last 2 years were very abnormal, that buyers were so thrilled to get something under contract and knew how hard it was that they were staying in deals that they wouldn't otherwise have. In a normal market, it's not uncommon to maybe have 5% of properties, 10% of properties, the contract not work out for one reason or another. Have you seen numbers on that, Jeb?
I haven't seen numbers, but I'm going to go a different direction than what you did on that question. And because obviously I work with buyers more than you do on the real estate side, right? And there's always the people that get cold feet, right? In any market, right? They think they're a home buyer, and maybe they are, but they get into contract and they just decide, hey, look, either I am scared, it's emotional, I can't do this, or it's not the right property, just something changed in their mindset, right? So that's one option. Option two is buyers started maybe looking a couple months ago, rates were lower. Now they get under contract, haven't really adjusted, go under contract, see the numbers from the lender and think, oh crap, this is way more than I thought it was going to be. I'm out, right? You got those. You got people that go under contract, they get an inspection done. Something comes back on the inspection that is major and they back out, or better yet, because I will tell you, I mean, I sell 30, 35 properties a year on average for however long, and rarely ever is anything major in a property. So more than likely it's something minor. Sometimes first-time buyers get cold feet over minor things and back out. So that's one thing. Or it could be the fact that, hey, I'm under contract. These things came up. I want the seller to do them. Seller says, screw you, man. Seller's market. I'm not doing anything. I don't have to do anything, right? Clean my hands, move on. No negotiation, buyer backs out. So there's so many different things. Appraisal comes in less. I mean, we could keep going on here. So don't look at every scenario and say, just summarize and say, well, it's because of this. There are so many things that can happen of reason that people back out. But I will tell you, a lot of times it's emotion. It's emotion from the buyer in some form or fashion. They didn't get what they wanted. They thought it was something it wasn't. They changed their mind. All of that. It's rarely to do with the property, in my experience, and more to do with the emotion of the buyer. Is that helpful?
And it's probably always the emotion of the buyer. Something gets the best of them. Something they don't like about the property. Something they don't like about the condition. Something they don't like about the terms of the financing. They didn't really understand when they were looking at the initial estimate, or it didn't sink into them. Like here's a good point, Jeb. The thing that I like to say, we deal with a lot of first-time buyers, and we have probably 25% of the time we have to have some sort of a conversation. Like, oh, I'm just not comfortable with that payment. I've never met a first-time buyer look and go, I'm cool with that payment, because it's generally, for us in California, it's a good bit higher than what their rent payment is. And with that, it's always going to be uncomfortable. Have also, in 27 years of doing this, very rarely had someone not adjust to it very quickly. I say very rarely because one of the first 3 purchase loans that I did actually was a first payment default, where they didn't make even the first payment, and that was due to a divorce situation. But most people, after a few months, go, okay, the lender was right. I am a reasonable credit risk. I can afford this. But all of those things, Jeb, back to this question, it's always an emotional reason from the buyer if they're going to back out. And now they have more leverage and also more confidence that they can go find a replacement property without killing themselves for another 6 months.
No, good. I mean, that's yeah. Again, so if that made sense to you guys, comment in there and let me know just to make sure. So we're gonna move on here. Here's a question I've never had, and quite frankly, I think I know the answer to it, but maybe I don't. Orange O pulp, orange zero pulp, no pulp, no orange juice pulp. Seller is requiring a post contingency that I can't sell for 2 years after purchase. Is that a thing? I'm going to go out and say no. I don't think that can be enforced from a seller side. I don't know that they have any legal recourse if you decide to sell a property. I'm not, Josh.
You can place deed restrictions on properties. Like one of the common examples,
Let's say the seller can do it. Like
the seller can absolutely do it.
Yeah?
Let's say that there is a church and there's a house next to the church, and the church would like to own it, a parsonage for the pastor. And someone may say, "Oh, my house is worth $500,000. You're the church. I'll sell it to you for $450,000, but we need a deed restriction that either you guys always own it or I get to buy it back at market value less $50,000." They can do it. My question to this question would be, is it a builder? Because I had heard, in the craziness of the last couple of years, that builders were doing things like this, or attempting to keep people from flipping the houses. If the construction period is a year and the house is going up 20% a year, how many people did we have on the show, Jeb, say, hey, we're getting ready to close and we have the house appraised for 25% more than what we paid? They were trying to prevent situations like that, of someone just buying and reselling that. They would put a deed restriction in there that you sell in the first 2 years, you have to sell it back to us for what you paid. So again, the legality of it, I wouldn't so much get into it, but I would love to know whether it's a builder, and if it's not a builder, what seller thinks that someone's actually, a private seller thinks that someone's actually gonna deal with this. Oh, here, orange zero pulp pops back up, says they're saying they just don't want to sell to flippers. Okay, cool, but I think they legally can do it depending on how it's worded and written.
Yeah, no, I learned. I mean, I understand the church thing, and I get that example, I guess. I mean, that's a good example. So yeah, so hopefully that makes sense to you there, Pulpy. Like that, just change their name, Pulpy. Anyhow, private owner. So yeah, I mean, if again, if you're going to be there anyway, who cares? If it gets the deal done, why do you care what the deed restriction is? I mean, unless it negatively affects you. So, but maybe have an attorney review. If you're in an attorney state, run it by an attorney and just say, hey, listen, this is where I'm at. Is this something I should be worried about or not? I think that might be the best answer, regardless of what you, whether you're in an attorney state.
And it may be as simple as talking to the seller and saying, listen, I'm not trying to flip this property. I might be comfortable with 12 months, but I don't know. What if I lose my job further down the line? That would be the thing. Since he followed up here that it is a private owner, have a conversation with them. Let them know, look, this is who I am. I'm a first-time buyer. I've never owned a home before. Or, hey,
do you know who I am?
do you know who I am? We're selling this property and buying this. I don't own any other property. I don't flip property. There's ways of assuring someone you're not going to flip their home versus putting a 2-year deed restriction in it. And it would be very interesting to see a private seller, how they would get that worded up and written into the deed restriction. And it would be interesting to see if your lender would be okay with it. Most likely they would not.
Good stuff. There you go. Appreciate it. Phil, appreciate you commenting back. Look forward to the call while you're in the Philippines. Maybe you can talk to my VAs over there. Give them a high five or something. Never met them. Just seen them, Good, hardworking people. Let's see here. We've got a couple questions on FHA, Josh, that I'm going to touch on real quick. Seems to be a popular loan program we talk about a lot. Gerald says, is an FHA loan good? And I'll answer this real quickly by saying, if it's the right loan for you, right? You've just got to understand what FHA is, right? And the pros and cons of that FHA loan. And if you want all of that, I've done videos extensively on it. But understand, probably in this market, the biggest risk, I guess, in any market is that you're putting, a minimal amount down. Part of that's going to get eaten up by the MIP, the upfront mortgage insurance premium. So, you need to have a longer term time horizon when thinking about FHA or any loan that doesn't require a large down payment. But Josh, how would you answer this question?
The simple answer is numbers never lie, and it varies from customer to customer whether it's a good loan for you. It's a great product. It's been around for a long time. It stood the test of time. It held up reasonably well during the last downturn. Their mortgage premium, their mortgage insurance fund did get drawn down below their required 2% levels, but it's a good program. So the question then becomes, what is most important to you as a borrower? Where does your credit score fall in? The lower you go on the credit score spectrum, the more advantageous FHA is. You may need flexibility in terms of debt to income ratios, where FHA is much more flexible. Those are the two biggest reasons. There are certain situations, to go back to flipping, FHA has an anti-flipping rule. A property that was purchased within the last 90 days cannot go under contract to an FHA buyer. So there's a million reasons why something's good or not good. Your loan officer needs to be able to show you side by side, if you qualify for both, a conventional loan and an FHA loan, and tell you the differences between the two. If you qualify for both and the payments are the same, I would tell you to go with the conventional loan for this simple reason. If you do a 3% down conventional, you have 3% equity in the property. If you put 3.5% down on an FHA, they then add 1.75% on top of that 96.5% loan. So you end up with a little over 1.5% equity, a little over 1.75% equity in the property. So as Jeb said, these are minimal down loans. We want to have as much cushion as we possibly can in there. So other things being equal, the conventional loan would be better, but they're rarely equal. My FHA buyers need to go that route for a reason. And when they need to go that route, FHA is a very good loan.
Good stuff. Good stuff. All right. Let's see here. There was another question following up to that. Anya says, who is mortgage insurance? Who covers the shortage after FHA short sale? So if somebody short sells an FHA loan, there was mortgage insurance on it. Is there any part of that premium due? What happens there, Josh?
So a lot of people always say, well, can I get rid of my PMI? Whenever I pay PMI, the P in PMI stands for private mortgage insurance. You're asking about an FHA loan. That is a mortgage insurance fund that is run by HUD. So the 1.75% upfront mortgage insurance fee premium, that goes to HUD, and they put that in their account. The 0.85% that you pay annually, that goes into the fund and covers the losses at that time. For whether it's short sale, foreclosure, any lender that takes losses, they make a claim against that fund and they get reimbursed. So what happens if it's a VA loan? Same thing. The Veterans Administration, they collect a VA funding fee on those. There's no monthly mortgage insurance, but they collect a VA funding fee and they pay off lenders that have claims when they take a loss. Same thing with USDA. USDA has a 1% upfront and then a 0.35 monthly. All of that goes into a fund and pays losses. And a conventional loan or a jumbo private loan, that is true private mortgage insurance. The lender goes to a private company, not the government that we just talked about, and they buy insurance, or they have you pay and buy them insurance to cover them for a percentage of the loss should you lose that home.
All right, good stuff. I'm going to just touch on this question real quick, and then we'll move on very quickly. I thought conventional down payment had to be 20%. It does not. It's a myth out there that you need 20% down for a conventional loan. You can get it down as low as 3%. But oftentimes, if you're putting 3% down on a conventional, FHA actually makes more sense just because of the payment, right? Josh said the numbers never lie. Just have the comparison. But yeah, 3, 5, 10%, you can get it any number in between. You can do between 3 and 20% in order and buy and get a conventional loan.
And tying this back to the last question, that 3%, 5%, 10%, 15% down, that's going to require private mortgage insurance. And if they tell you, hey, there's no mortgage insurance on this, that means you're paying a higher interest rate, and unbeknownst to you on the backside, they're buying mortgage insurance. So there's always going to be mortgage insurance in a conventional loan with less than 20% down. And Jeb, I don't know if you saw, Naptural came back with a follow-up with FHA. You put down less, 3.5% conventional costs more to put down. Like we just went through, that is not true. You can put even less down in a 3% down conventional loan. But as Jeb said, other than the most well-qualified borrowers, a 3% down conventional is generally going to have a higher payment than the FHA does.
Good stuff. Mr. Abs asked a question what we were talking about earlier. Said, I didn't realize it was that easy just to get out from under contract just because the rates rose to a number that you aren't comfortable with at that moment. I thought you needed to lock rates. So you don't always need to lock the rates. We were talking about new construction. You don't need to lock the rate just because you're under contract, right? At some point, you've got to lock it before you close. But it's not always that easy with new construction. In fact, that was that was part of the conversation we had when I was talking to those two people. It was Levi Lassick, living in Dallas, Texas. That was his channel. And then the other was Melanie Loves Tampa Bay. So both markets, both new construction said, yeah, buyers aren't really backing out because they have a pretty substantial down payment. And if they do back out, they're going to lose that down payment based on the way the contract was worded. So some people might be willing to walk away from that. Most people aren't. And that's a reason that, the numbers are probably not going to go significantly higher because, there's money tied up in that.
And if you remember,
and the builders are willing to pay down that rate. Yeah.
In the spring, we had a lot of cancellations, and people were shocked and amazed at this. And you're like, why is that surprising to you when over a brief period of time, rates shot up 2%? And the people that were going to back out on their homes that weren't yet built have mostly backed out. There may still be some people backing out of transactions, but as long as rates stay level, people that are putting something under contract right now are having a better idea of what that looks like. Lenders or builders lenders have done a better job of buying forward commitments, offering long-term rate locks. Builders are smart. They want to lock in their profits. They're changing the way their contracts are worded. They're having their lenders offer better options. And our market, non-builders lenders have better long-term rate lock options, float down options. The market adjusts when things change. So that initial shock of the first 6 months of this year, we've seen the most of it. I'm not saying no one's going to back out because of their financing going forward, but we've seen the worst of it.
Well, and one thing I want to point out here, a couple months ago, we talked about what happens with home builders if we go into a recession. And we said that home builders basically stop building, or they're going to limit the number of properties that they go under contract or permits pulled or what have you. Guess what, guys? Latest number says, home builders are kind of backing away from building new homes. Guess what that does? Everybody's like, whoa, it's a sign the market's falling. It's a sign that you're going to have an inventory problem for a lot longer than you would otherwise. That's what it's a sign of. And it's hard to see at the moment because there's a lot of, fog out there with regards to the future of real estate. But I can tell you, as the market corrects, at some point it will. Inventory is going to continue to be a problem because without new construction, you're not solving the underlying issue that we have here. So anyway, I digress and I move on. Josh, let's see here. We've been on almost an hour, asking that you guys hit that like and subscribe button. We appreciate it. It lets us know that you actually like us being here. We do this every Wednesday, typically every Wednesday for 2 hours. Going to be around 100 hours of free content, guys, educating you guys. And all we ask is that you push the little button. So please do that. It helps. It helps. It helps. Okay. So Josh, let's see here. Let's get you a question. Multifamily.
Yeah, I
What's
was gonna say
that?
we got a lot of questions coming in
We
here.
do. We got a lot of questions and a couple on multifamily. So this one is by Kane. Says, how can I buy a multifamily as my first home? And then we've got Caesar saying, any way to put less than 20% down on a fourplex investment property. Fourplex, multifamily, same thing. So let's address Caesar's question and Kane's question simultaneously if you can.
Yeah. Doing it as your first home is going to be difficult because Caesar had a good question there. How do I do it? Can I do it with 20% down, with less than 25%? Fannie and Freddie require on 3 to 4 units 25% down. So you can do it. It's going to be a non-Fannie Mae Freddie Mac loan. So it's going to be a local bank or portfolio lender. And if we're going to do it with less than 20% down, then you're getting to like sort of an alternative lender, and you're going to pay a premium on that interest rate. The way around it is with an FHA loan. Kane, I don't know where you're located. One of the biggest volume of disappointing inquiries that we get from the show and from other shows on YouTube that connect us with folks is people who've watched a video and they see that I can buy a 3 or a 4 unit building with FHA financing with 3.5% down. That's 100% true. But FHA has something called, and it's for only for owner occupied properties, not for rental properties that you're not going to live in. But FHA has something called their self-sufficiency test. And it's a weird thing to understand because you're going to live in one of those 4 units, but you have to take the rent from all 4 units, the market rents, multiply it by 75% to allow for a vacancy and expense factor. And that has to exceed your monthly payment. With prices as high as they are and with rates up from where they are, in California, I haven't seen a 3 or 4 unit building pass that self-sufficiency test with a minimum down FHA in probably 7 or 8 years. So I know there are parts of the country, we may have talked about this in the show before. I have a buddy in Minneapolis. He lends in Minnesota and Wisconsin, and he helps millennial first time buyers, 50 or 60 of them a year, buy 3 and 4 unit first properties using FHA financing because the prices relative to the rents work and they can pass the self-sufficiency test. So yeah, you can do it, but if you can't use FHA financing, you're looking at a big down payment, and those multifamilies are generally more expensive than a single family, and it becomes a big amount of money and it's very difficult. So I love it that we get this question a lot, that younger people are thinking, hey, I need to own real estate. Here's a way that I could afford it better and lock in my housing cost and maybe have an investment at the same time. It's really hard to do with less than 20% down.
Good stuff. Good stuff. All right. So I just want to tell you, Josh, I'm pretty disappointed in the number of people that hit the like button after the last time I asked them to do it. I'm just saying. I just wanted to throw that out there. Nothing against these people, but there was 200 plus watching. Nobody did it. All right. What does it mean when you say builders are buying the interest rate down? So, seller, somebody asked earlier about closing costs from a seller, which I think it was Jennifer. I will check. I will click on that next. But what happens is a seller can offer a credit to the buyer to use towards a buy down on an interest rate, a discount points on an interest rate, which basically means that if Josh quotes me an interest rate today of say 5%, he might give me an option and say, hey, Jeb, listen, we can get you actually down to 4.75%, but it's going to cost you a point, Josh, or a point and a half, 2 points. What is it? I mean, what's a 1/4%? Is it
a 1/4% rule of thumb is typically 1 point.
okay?
Right now in the current market, we talked about earlier in the show, we're seeing more 1 point's getting you more like a 0.5% right now.
Okay, so in this case, let's just say that Josh is saying, that 1/4% is going to cost me a 1% fee. Well, if I'm buying a $500,000 home, that's $5,000. Well, the builder might say, listen, instead of you walking away, I'm willing to keep you in the contract. I'm willing to buy down, give you a $10,000 credit, and that might get you a 0.5% or 0.75% better in the interest rate, which at the end of the day is going to affect your monthly payment more than having the seller, the builder, reduce the price by say 25,000. I mean, we did an example in another video where we actually talked about this. You actually save more money by taking on that lower interest rate. Keeps you under contract, keeps you from losing your deposit. So that's an option. And there are some other options out there with buy downs, which we're not going to go in detail on today's video. But essentially what it is it gives you an opportunity to buy down the rate, maybe more the first year. It lessens the second year and third year. And Josh, if you want to explain it briefly, go into it. But I know it
In terms of
can be
the
a rabbit hole,
a buy down,
like a two
yeah,
for one buy down, like that sort
we
of thing.
can essentially what you're doing is there's subsidizing the interest rate for the first couple of years. The builder can do that for you to ease you into a payment. So if we say we want a permanent buy down, Jeb says 2 points drops you a 0.5%. Well, that same 2%, if we want a temporary buy down, we'll drop that rate 2% for the first year, 1% for the second year, and then you end up at the current market rate as long as someone paid that money up front. So that's the way builders are using it as an incentive to help first-time buyers kind of keep the payment down, ease into the market. And the cool thing with a 2-1 buy down, a 1-0 buy down, a 3-2 buy down, all different versions of that, is that money is set into an escrow account to basically subsidize the payment for the first couple of years, and the lender keeps that. If rates drop, you can refinance and you can get that money back. If you do a permanent buy down, once you pay those points, that money's gone.
Good stuff. I said I would address Jessica's question afterwards. So Jessica's question is, can you explain how some people get closing costs covered? People say either seller or lender credit. So when you put in an offer to buy a house, you can ask the seller, if let's just use an example again of $500,000. Property is listed for $500,000. You think it's worth 490 or whatever. Maybe you think it's worth 500,000. I don't know. But you put in an offer, say for 490, but then you say, with this offer at 490, I'd like to have the seller pay $5,000 towards closing costs. So the net to the seller is really 485 if you look at it that way. But you can do this anyway, right? I'm just giving you an example. And you can ask for that money to be used towards your closing costs. Now, over the last 2 years, sellers would laugh at this because there was multiple offers. There were people going way above the asking price. There was all this competition. There was no reason that the seller would even consider a credit to buyers in that fashion. And we'll talk about how that might be different wording and whatever back then. But as we're getting into a changing market now, it's more likely that a seller might consider that. Now, this was part of our market prior to the pandemic. People would get closing cost credit. I mean, I've had it done many, many times in my career over the course of my career. So it's not abnormal to have that happen. It was just last 2 years, it's been abnormal for it to happen because of the craziness. Now, sometimes a credit might come as you get into contract. You didn't initially ask for a credit, right? You just put your offer in. And then something happens in the contract, there's some repairs, there's something comes up in the contract, and you say, you know what, I'm not going to ask you for repairs, but I'd like to ask you for $5,000 towards my closing cost credit, right? Instead of you fixing these items, I'd like to ask that you give me a credit towards my closing costs, because you can't do a credit towards repairs through a contract. Most contracts don't allow it. Most lenders don't allow it because they want to see those repairs completed prior to the close of escrow. So it's done in the form of closing costs. So that could be another way that you might see it. And then the other way you mentioned, there's a lender credit. So Josh, a moment ago, I gave you the example of, he's quoting me an interest rate of 5%, and he might give me an option of a buy down, where I could take the rate to 4.75 by paying a point or whatever. He might also give me the option of saying, hey, Jeb, you can take 5.25. And with that 5.25, you'll actually get, 0.5% towards your closing cost that could be used as a credit. So there's a couple of different ways to have the conversation, to ask for credits. But the majority of it needs to be, done prior to going under contract. You need to have those conversations with your realtor, your lender, prior to getting in the process and then trying to figure it out. Is that good?
Jeb, that is really good. And better yet, we don't need to do the show anymore. These people can answer their own questions.
So we got somebody answering it.
So, Neptural follows up. I had to bid a little higher too. There's still competition,
right?
And sometimes it may take more than once. 100% correct. If you need that money, so oftentimes, say FHA or that conventional 3% down, and that's all you have. I don't have an extra nickel. We don't have an option. We have to get that credit. So you have to offer a little more. You may have to wait and find the right property. but that's 100% the right answer.
And
And it's
Jessica,
definitely a good thing.
you always shoot your shot. Always,
If you don't
right?
ask,
Might
the
not.
answer is always no.
Yeah, exactly. Right. You gotta put it out there. And sometimes, you don't necessarily have to have the conversation in writing, right? Yeah, it might be, hey Jeb, I like this property right here. Can we see if we can get a credit? And your agent calls and has a conversation with the listing agent. Hey, listen, client likes the property. They're willing to come in at around the asking price. But I was wondering, hey, listen, do you think we could ask for closing cost credit? Maybe, we're willing to go, the property's listed at 500. We're willing to make an offer at like 505, a little bit higher, and ask for $5,000 credit. So the seller still gets what they want. And then we're able to get the money on our side to be able to purchase the house. That works too. Now you're in a market where things are slowing down, changing. You might be able to get it less and still get that credit. So just have the conversation. Sometimes it doesn't
One
have to be in writing.
One last note there, Jeb,
Yep.
to throw in. It is important. Property has to be able to appraise. If that
Yes.
500 and you're saying I'll offer you 505 to get a 5,000 seller credit, and the appraisal comes in at 5, the seller's going to come back and go, "Cool, you can have the house for 5, but I ain't giving you the $5,000."
Yeah, agreed. So just, again, that needs to be done, and that's a conversation you have up front as well. Kim asked a question I don't know what we've ever gotten. Can you still buy a home if you make monthly payments to owe federal taxes? So if you owe taxes, you're on let's just say, well, if you owe taxes and you're not on a payment plan, you might be screwed. But if you're on some sort of payment plan, I think it's just factored in, Josh. Is that right?
Absolutely. The payment plan is acceptable. Depending on the program, you may have to have made 3 payments ahead of time. The only situation where it's really not acceptable is many jumbo lenders look at this and they're just like, no, 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 thanks. We don't want that. But conventional, so Fannie, Freddie, FHA, VA, they will all allow you to be in a payment plan as long as it's been established and you're making payments and they can see that documentation.
All right, I'm going to take this minute to apologize. After I said that, we had 30 people come in and hit the thumbs up, Josh. So, they like us. I think they like us.
You even got a Facebook like, and there's only 0 viewers on Facebook right now. So they gave you
I
the
don't.
like and bailed.
Nicole Cross. I don't even know who that is. Do you know Nicole? Maybe I
I
do.
don't.
I don't know. Maybe I know Nicole Cross. Maybe it's a maiden name or not a maiden name. Anyway, let's see here. Josh, can you help with loans in Texas?
We do have the ability. We recently
Construction loan.
added that. So the follow-up question there, the one-time close construction loan, not a specialty of ours. I know it's much more common in other parts of the area, the country. So it may be something that we're going to need to learn. But reach out. I would definitely love to talk to you about it. If we don't feel comfortable with it, we can get you connected with a couple of pros who are in Texas who can.
There you go. And if you're in another state watching, you're in California, want to get connected with a real estate agent, an expert, real estate mortgage professional, a mortgage professional, an expert. There's a link scrolling at the bottom there. If you click on that or go to that website, ask you a couple questions, no cost, connect you with somebody that can guide you in the right direction. Let's see here. Josh, we got Colin asking, what does it mean to have a positively cash flowing property? So when you have an investment property or any property for that matter, you have some cost associated with that property. Most people have a mortgage. They're going to have taxes. They're going to have insurance. So I'm going to use this from an investment standpoint because typically that's where we're talking about positive cash flow on a property. So you have a mortgage, you have taxes, you have insurance. You might have property management costs. You have different things associated with that property that you're going to be responsible for paying. So in this example, let's just say all of those things added up, the things we just mentioned are $1,000. And your rent on that property, the amount of rent coming into that property is, say, $1,200. In that case, you got $200 in positive cash flow because you're $1,200 in rent, your expenses are $1,000. That $200 is positive cash flow. Now, take it the other direction where you've got that $1,000 in payments, if you will, and you're only bringing in $800 in rent or $1,000 in rent. You might be $200 negative in cash flow or break even in cash flow. So it's really your cost versus how much money that property is bringing in determines whether or not you have positive and or negative cash flow. So hopefully that's helpful for you. Josh, what is the difference between a high balance loan and a jumbo loan?
So the simple difference, these are all above the standard conforming limit this year, 647,200. So a high balance loan in high cost areas, Fannie Mae and Freddie Mac will allow you to do a loan up to 150%. So not all areas go all the way up to the 150%. Orange, LA County, San Jose, a lot of the high cost areas in California will go all the way to 150%. And you follow the same guidelines pretty much, except you can't do a 3% down. You can only do a 5% down. Jumbo loan is not going to Fannie Mae or Freddie Mac. It's going to a private lender, bank, credit union, and they make their own guidelines on that. So we actually have access to an awesome program with this that not a lot of lenders do. And when we're pricing out most of our high balance stuff right now, this year, Fannie Mae and Freddie Mac added back in April a 1 point fee to all purchases, high balance purchases. And there already was one for cash out refinances. So basically, all high balance loans are going to be a point higher in cost, which we talked about when you're buying a point on the way down. That's helpful that we can get almost a half point savings right now instead of the normal quarter. Now, it works the opposite. When there's an additional 1 point cost, now that's like a 0.5% higher. So our portfolio lender, when we're talking to people that are in that high balance and above range, we have a portfolio lender that basically underwrites to Fannie Mae guidelines. We'll do 3% down up to a million, and they have lower interest rates because they don't have that high balance hit. So when you're in that area, it almost becomes more important to shop because it comes down to what your lender has access to. Everyone has access to high balance, but there are going to be some pretty significant and large differences with jumbo loans. Most jumbo lenders are more restrictive, bigger down payment, all that stuff, but there are private lenders out there that are fairly competitive, real competitive with Fannie Freddie high balance stuff.
All right. Follow up on Colin's question earlier, or I guess this was the question prior to that question. For people in their early 20s, would you say cash flow is super important, or is it just a matter of accumulating rental properties where the rent covers the mortgage for appreciation, future net worth? So, personally speaking, I would need some positive cash flow. Breaking even might work if you have another plan, but you don't want a bunch of properties that just break even, especially if you're putting a decent amount of money down on these. Rental property, you're going to need 25% down, 20% down on most of these. So you're putting up a substantial amount of money. And if you're not bringing any money back, your cash on cash return is zero. And so you need something. Otherwise, your money's probably better put in some sort of a different asset, in my opinion. Now, to each his own.
Nothing Jeb said is wrong, but each deal is unique, and I like to analyze the numbers. We bought a property back in 2010 that it was slightly cash flow negative at current rents. At market rents, it was barely positive, but there were some really big reasons to buy that property. And we're getting old, Jeb. 12 years later, the property's doubled in value. It's going to be paid off in 2 years, and it's hugely cash flow positive. So you kind of want to have to look at it, say, where are current rents? Can I increase rents going forward? Like Jeb, just kind of expand on this. We were talking about a situation for you. Do you look at buying a couple of properties cash, or would you buy twice that many properties and finance them 50%? Well, now when you're financing them, you have less cash flow, and we want to look at making sure you have some money set aside. Something's going to happen. For those of you that were watching this time last year, which I know a lot of the audience here, once you find a home, moves on. But if you were watching this time last year, bought a house from a past client, got it at a good discount because he had destroyed it. We put it all back together, rented it, and we're $600 positive each month. My mortgage is 32 and change. We rent it for 38.50. I look at that as almost break even, because the reality is I put $700, $600 a month, $7,200 for the year. If those folks move out, I'm going to have at least 2 weeks where that property is empty. I'm going to have a couple $1,000s of cleanup and expense and marketing and advertising and all that fun stuff. So it's that amount is slightly positive. So you got to look at all of those things there. But there can be specific deals with something unique to them that you would be okay with even slightly negative cash flow, but you want to make sure you have a very strong hand in terms of some reserves if you're looking at doing stuff like that.
Nope, good stuff there. Let's see. I saw another one that was good. Alex asked a question. Bought a house that needs lots of upgrades. I've been wondering if I should do a HELOC and do it all at once or do it in phases and pay cash. So, Josh, in this environment, HELOCs, how common are they? Pretty common, I think. How easy are they to qualify? Do you use your money in your property or cash to do things?
Very common. Lots of lenders offering them, very attractive to people, especially if they need small amounts of money relative to the size of their first mortgage when you look at a blended rate. So even with prime as high as it is and a margin of 1.5 on top of that, so most of these HELOCs are in the 7 to 8% range right now for even the best qualified borrowers. But if you're borrowing $40,000 and you have a $500,000 first mortgage at 3%, still probably makes sense versus doing a cash out refinance. So that's kind of what you want to look at in terms of how hard is it to get qualified for them. Not hard, but a little harder than a first mortgage. I would say the underwriting guidelines are a little bit stricter because there's more risk to the lender. My preference on this, we're in a weird spot, Jeb, in the market. As recently as 6 months ago, every contractor on the planet was booked solid for the next 2 years. Materials are expensive. You were going to pay for labor and materials a lot and wait. So if you could do it bit by bit, it might help you, but you might have to bundle it all together to get a contractor to be willing to do your job. If you have a $10,000 bathroom remodel and that's it, they may go, oh, I'm waiting for a $80,000 whole house remodel. So it just depends on where you're at with that. And Jeb, there was another part, he'd asked multiple parts of the question. The other one is, how does this affect me being reassessed? If I go back 5 different times for permits, are they going to reassess me more than if I do one bigger project? No way of answering that. But what I can say in my experience, we put a pool in last year. We got reassessed. It wasn't reassessed as much as it could have been. So with that, it doesn't seem as though they add as much as the fair market value adds to your home. So for whatever you're looking at, I don't know that that is a factor at all. It really comes down to your bargaining power with a contractor right now. Or if you're going to do it yourself, I mean, that would be a different thing. If you want to save 10,000 and then knock out a piece of it yourself and then do that. So not a super easy way to answer the question, but they're all good options. It comes down to your specific situation.
All right, good stuff. There's a couple questions I'm going to answer real quickly here. Kim says, as the interest rates increase, does it affect HOA fees? It does not. So nothing there, but inflation could affect those HOA fees as if your budget changes in your community, but that's a whole different question. But it wouldn't affect it without you knowing in advance. Patricia says, we went under contract in March for a new build that was supposed to be finished this month. Now it's looking like October. House was worth $40K less this time last year. So your house is appreciated 40 grand and you're asking, can you negotiate? I'm going to tell you probably not. But again, we said earlier, shoot your shot. Try, ask, see what happens. No, nothing wrong with asking and seeing where it goes. They might come in and say they're willing to pay down some closing costs or give you a credit or something. Last one, I've heard from Don. I've heard sellers frown upon FHA loans in the current market. I'm located in California. Area is priced sky high in the desirable neighborhoods with no new construction. How do I compete? As the market slows, you're going to have a better opportunity to compete. Now, when I say slow, I don't mean declining, huge declines in prices or anything like that, but you're going into a slower time in the year, naturally, seasonality. Less buyers out there looking, affordability has affected some buyers, whatever. This might be the opportunity over the next couple of months to shoot your shot and get into a property. So I wouldn't be completely discouraged because you have FHA, because I think there's an opportunity out there for it. All right, meteor shower, Josh. What are the benefits and cons of no doc loans? I have 40% down, 790 credit. So I guess I qualify. I asked a lender, but just wanted a second opinion. So going to pay what, higher rates on no doc? That's the primary con, I think.
This is a very short answer. The benefit is it's much easier for you. The con is that it's much more expensive. Not a little bit, a lot, a big difference. And when we're talking true no doc, because that's a level above and beyond with the qualified mortgage rules and ability to repay guidelines. even a bank statement loan where you're showing, hey, here's 12 months of bank statements, or an ability to repay in full. I've got $2 million in the bank. I'm buying $1 million property and getting an $800,000 loan. If you show an ability to repay and document it in one way or another, you're going to get better terms. So you're looking at, if we're saying low fives for a full doc loan for the most part, low sevens for the most part for a bank statement loan. These loans are up in the 8.5% range. So if you can document your income in one way or the other, it's generally worth the additional trouble to do it. And if you could fully qualify, give them pay stubs, W-2s, tax returns, and this is a no-brainer. That extra hassle is well worth the monthly savings.
Good stuff there. So hopefully that helped you out. Meteor Shower, you had another question. Do you think around 1 year from now, maybe better than now to buy a property in New York City? What are your predictions? Don't have any. Don't know New York City well enough to give you any predictions. And I don't know what you mean by better. Is it, you mean more inventory? Do you mean lower prices? Do you mean better interest rates? There's a lot going on there. I think I don't know that there's huge changes in the market in the next 6 months, a year from now. I don't know, because I don't know where inflation, I don't know where the Fed does with Fed funds rate. There's some unknowns there, but clarification helps. But either way, I don't know New York City. So unfortunately, I can guide you to somebody. If you need somebody, there's a link scrolling at the bottom. But me personally, you won't want my opinion either way. Josh, here's a question. Something similar came up the other day, but this one I think we can answer. If I build a tiny home in my backyard, do I need a permit for that? So yes, in theory, yes, you need a permit. Even though the state of California, if you're in California, SB 989, I don't even know if those were the two that addressed tiny homes. I think it was one before that. But either way, they allow them now, or ADUs. They allow lot splitting, all that stuff, but you're supposed to have permits in order to do it. So yes, can you do it without one? Sure. But you always have the chance of them finding out and you getting fined during the process. But the question I had, Josh, is, I was on Christina Smallhorn's channel on Sunday, and somebody asked the question of, if I put an ADU on my lot, does title now have to reflect that structure as part of the deed, if you will, if it's permitted with the county? Does it become part of the title of that property?
I don't believe so, because you didn't make it into a duplex. If it was planned and permitted and went through, it should show additional square footage, should show an additional structure, an outbuilding. It depends on how they're doing it. Does it have,
I didn't know.
Does it have cooking facilities? Does it have bathing facilities? Does it have a toilet? That type of stuff. But here in California, if you look at a property with an ADU, it doesn't suddenly show as units. It may show.
Agreed.
You know what I'm saying? So I don't think, for the most part.
I said the same thing, but then I was like, honestly, I don't really know the answer to that, because it's changing so much. So anyway, a little off topic, but a little on topic. Jasmine is asking, do you usually provide proof of funds to the seller as part of your offer? Does it have to be all liquid, or can you show brokerage accounts? So I do show proof of funds with regards to the down payment. Now, what does that mean? That means if I'm making an offer for Josh, and Josh is putting 20% down on a property, I submit the offer itself with the disclosures that are required. I submit a pre-approval letter, a lot of times a package. If there's, a desktop underwriter or something like that, I include that. Credit scores, if they're solid, I include the credit scores.
Or we hide them if they're not.
Yeah, if they're not. And then I provide proof of funds, right? I want to show the seller, hey, look, we actually have the money we need in order to do that. Now, we're hiding bank account numbers and all that stuff. But what it is it's just showing the seller the full picture, because oftentimes you'd be surprised of where some of this money comes from, right? Somebody is buying your house, they're putting 20% down, and little do you know, they're actually refinancing another property to pull that cash out to get the down payment. They don't even have it, and we didn't know anything about the other refinance. So all we're doing up front is verifying it, and making sure that the transaction's there. If I'm the listing agent, if I'm the buyer, I'm showing them it's there. Now, can it be in brokerage accounts? Sure, it can. It doesn't, and the thing is, it doesn't actually have to be coming from the account that you show me, right? So you might have a Fidelity account that has $100,000 in it, and all you're putting is $20,000 down on buying a house. I just need to show the seller, hey, listen, they have money here. I don't care where you pull it from. Now, the lender cares, but I don't care with regards to the offer. So hopefully that's helpful. Josh, that is not a question. Let's go with Gerald. Gerald's got a really simple one. This was from 5 o'clock, so this is a long time ago. If Gerald's still here, it's a miracle, but we will answer the question anyway because it kind of goes into Crystal's question here. Do you think the prices will continue to fall? I'm not even sure.
Loaded question. That assumes
yes.
they
Well,
are. They have started
so
falling.
between the two here, will the beginning of 2023 be a good time to be a first-time home buyer? Josh, any indication of that time of the year or
Well,
what
here,
you expect?
let me just say how this advice differs. If you, again, if you were here last year and watching this, we said home prices are appreciating far faster than most people with a reasonable income can save. You need to step into the market because rates are great and home prices are shooting up rapidly. Whether they flatline, whether they decrease a little bit or continue to go up, I don't think there's going to be an appreciable difference between now and January. So if you have a reason why you want to wait until January, you can save some more money, just a better time in your life. You need to finish up school, you need to get married, any of a million reasons. I don't see any reason not to wait till January. It's not going to be a worse time. I don't expect rates to be significantly higher. They could be a little lower. I don't think they're going to be a ton lower. I don't expect them to be much higher. I don't expect home prices to be vastly different. Depending on where you're at in the country, you've got seasonality in terms of homes. You probably have less competition in January. Wait till after the Super Bowl and that changes. But from the realtor side, Jeb, what do you see on that?
I see a market that's much like the one we're in now. There's going to be some properties out there, some price reductions. It depends on when you buy in 2023. If January is probably, as a first-time home buyer looking to get in and not get, scared of the market. It's before the market heats up. It's if you're looking for a deal, that's probably the better time of the year. But I think as the fall comes around, again, a lot of it the spring comes around, the market's probably going to pick up. It just happens every year. Seasonality, that's, typically when the most transaction happens. But a lot of it has to do with rates and inflation and some of these things that we just don't know the direction while we think, it's going to be like now. That would be my prediction. It's unknown at the moment. But I wouldn't be honestly to be surprised to see house prices where they are now. Then I don't know that you're going to see big declines between now and then. Maybe a couple thousand lower here and there, depending on your market, some changes, but I don't think anything crazy. But I think you'll see less inventory during that time of year than now, just because you're coming into that slow time at the beginning of the year anyhow. But that all changes. All right. So I kind of went off a little bit on that one, but so hopefully that was helpful for you. But let's see here. And Crystal, do I think home prices will fall? In some markets, maybe. I mean, it depends on what your definition of fall is. Could some markets decline in prices? Sure. Could some markets still appreciate in price? Sure. Depends on the market you're in. Real estate's local. We talk about that. I think what you see more than anything else is some sideways movement in house prices, meaning they can go up a couple percent, down a couple percent. And I think that could honestly continue for years. I mean, I'm guessing merely, but I think that's the more likely case versus falling and or going sky high. Anything you want to jump on that, Josh?
No, we kind of covered it at the beginning of the show. I don't expect a huge increase or decrease. It shouldn't be a factor in someone's decision making right now if it's the right time for them to buy.
Awesome. Steven is in Costa Mesa, my market, Huntington Beach border. Reach out, Steve. We can talk. Steven. Let's see. Unless you're a realtor, you probably don't want to talk to me. Let's see here. Clara says, I'm putting solar panels on a new triplex. This one, I'm a little bit, I'm wondering. I want to know the reasons here. With net metering that has 0% down, what would you recommend billing tenants? Sub-metering, or was I leaning on basing it off of square footage? So I'm wondering, you got a triplex. Typically, tenants pay their own rents, their own utilities in this situation. I mean, why solar panels? I mean, I get 0 down, but there's typically a cost associated with it. Either that or they're leasing your roof for the solar panels. And either way, I'm not a fan of solar. So I'm probably a little bit biased against the whole thing to start with. I'll be completely honest. But if you got a rental property, a triplex, and you're not living in it at all, why the hell do you care if it has free energy or not? I guess. I mean, I'd like to know the answer. So Josh, anything I'm missing on that, or?
No, I would think the same thing. You can figure out how to allocate the costs. Maybe you can go to the electric company, find out what that's looking like right now on an average per unit, and allocate that. I just think it's going to be confusing to your potential tenant. Hey, either I'm going to charge you more rent because you don't have an electric bill, and they're going to kind of get it but still be confused, or you can say, hey, here's the rent plus you're going to pay me this because there's no electric bill. And I'm in the same camp as Jeb. Maybe 15, 20 years in the future, this solar is going to be awesome and so efficient that we all should have it. But right now, the cost to benefit just isn't there.
Yeah, so she's saying it's an ADU and a junior ADU. She can make money from electric usage, and the tenants can save money. I mean, if it pencils out, sure. Again, I've yet to see a situation personally where solar has actually made sense. I mean, if you're in an area that has your utility bills are through the roof, you run the AC nonstop, you have a pool that's heated constantly, a jacuzzi, that situation, and the lease payment, or I mean the payment to buy those solar panels is significantly less than your utility bill, and you're going to pay it off in just a few years, maybe. But the problem is that's not normally the case. It's a break-even situation where you're paying essentially what you'd be paying in electricity, and it's going to take you 30 years to pay it off. Well, that doesn't really sound like a good deal to me. And again, I'm not talking about your situation. I'm just talking about my biases against this whole thing to start with. So you take my opinion with a grain of salt because of that. And that's why I thought it was important to put out there. But I don't know if you can make money and the money makes sense. Great. But understand at some point, roofs have to be replaced. Things need to be changed. Maintenance on these panels, that's stuff that needs to be factored in there, right? Is if you got to replace the roof on this, all those panels got to be removed and then put back on. And if maintenance needs to be done on these, there's a warranty on them. I think it's like 10 years. But what happens after that? And just understand how efficient these things will be in 5-10 years from now. Again, you'll be able to do the roof and in the material. So it's all one. I mean, you can do that now, but it's just the technology will get better. So again, I digress and I move on. So I'm sure we weren't much help.
I'm waiting until they have a Tesla roof that isn't hideous. As soon as it looks like a real roof and is solar, I'm in.
I mean, I thought I saw one, but I don't know if those are actually, if people actually do those or not.
There's one around the corner from my house, and it's ugly. I mean, it's cool, but it's ugly.
Well, there you go. Anyhow, all right. So let's see. We got one more question here. This was from 505. BP is long gone. Could you share your thoughts on San Diego new construction market? Is it a good time to go for new construction with rates settling? So to each his own. Just understand new construction is not always what it's made up to be. Typically, there are some higher costs associated with owning new construction that we've talked about, and I've talked about in several videos over the years. Is there Mellarus on that? I was actually talking to brother-in-law today, or sister-in-law today, Josh, about a house in Irvine. And she sent me a new construction property in Irvine, and I said, what's the Mellarus on it? She wasn't sure, and she said, well, typically, what's the rate? And I said, well, it can change, but on that property, it takes your property taxes from roughly 1.1%, and probably take it to like 1.5, maybe even 1.8, depending on the market and all that stuff. And let me tell you what that on a $1.4 million property, from 1.1 tax basis to 1.5 tax basis, that's $500 a month. That's a big difference in that property. So with new construction, again, you might not have that in that market, but just some things to factor in. I don't know San Diego well enough to be able to give you thoughts on new construction in those markets or whatever, but I can put you in touch with somebody if you do. I got a lot of good buddies down there that do real estate, and happy to refer you. Josh, opinion. Let's see here. Anna, opinion on Cerritos area. It's here locally. It's still a market that is more affordable than coastal Orange County. People are going to continue to digress. Digress. People are going to continue to move there because of the affordability. I think it's still a decent market. I don't, have any stats for you at the moment, but if you want to have a conversation, reach out. All right, Josh, dude, I think we're done. Like we just finished.
We answered all the questions. They fired them out rapid, and we gave concise answers tonight.
But they don't know what's coming, and I don't even know if we know what's coming. So I'll just set this up. We're probably going to lose. We're at 190 people. We're going to lose people significantly when I set this up. But so recently I had some guy reach out to me. I get promotion stuff all the time. People saying, "Hey, do you want to promote this? Do you want to do that?" And I say, "No, I don't. I'm not going to promote anything." And this guy said, "Hey, listen, I've got this box of treats. I love treats." And he said,
"Don't we all love treats?
They're from another country, and blah blah blah. Would you do a video on your channel?" I said, "Look, I'm not going to promote anything, but if you want to send me the box for free, I'll talk about it on the channel, and maybe we'll eat some of these things." And so this box has been sitting on my desk for better part of a month. And they sent me treats from Serbia and Croatia. And so Josh has some of these treats on his desk. I don't know what he has. I have some of these treats over here. I have a list of what all these things are. So I figured at some point we can probably taste some of these things, right? That's probably what we should do. But we've got Animal Kingdom by Cross. These are like animal cookies, I think. Like Prima pretzel sticks. Smoky by Stark. Like, I don't even know. Like, some of this stuff I can't even pronounce what it is. Eugenia Original. It's a biscuit filled with chocolate cream, making it a perfect cookie to enjoy any time of the day. So, Josh, at some point, I think we should eat these things and just
I'm nervous.
Tell people.
This showed up in the mail from someone on the other side of the planet.
I'll give you. It came in a nicely packaged box. This thing. Can you see that? Is that cool for us? Yeah.
Yeah.
So it's called a treat box. Trytreats.com. In fact, there's a link in the description below if you want to check them out. They'll give you 15% off your order. I've never done a promotion video, so I suck at this.
Anything for treats, right?
But I thought, you know what? But here's the part is, dude, I haven't even eaten dinner yet. Like, is this going to ruin my dinner? I tell my kids all the time, dude, no treats before dinner. I'm breaking the rules here, bro. I don't know if this is good. But anyhow, so let's see what we got here, Josh. We can answer questions while we go through this. So I'll answer some questions. And we can eat some snacks, and you can tell me what you think. Joe says, "What do you think about purchase?" What is that? Let's see what that one is. Read what it is.
No, go to this one. They're both good.
What do you think about purchasing a house in Hesperia, California, and working in San Dimas? I think that's I don't know where's San Dimas compared to Hesperia?
Everything is far. It's not that far.
Okay.
Relative to, like, if you're all the way in LA, San Dimas is out like the 10 and the 210. So you're kind of on your way. You're just going to hit the 10, and you're going to go up, and you're going to go over the pass. So what I will say is, whatever you imagine and think that traffic and commute is, it's going to be much, much worse. I have literally had 3 clients do this and sell within 2 years to come back to Orange or LA County. And one of them couldn't buy. They were like, I don't want to own a home this much. So that's the only reason why I would share that. Not because I feel that way. I love home ownership. That it is a brutal commute, even though San Dimas is a lot closer than if you had to go into downtown LA or Downey or something like that. I would be very, very careful.
There you go. Good stuff. I wouldn't have been able to help you because I didn't even know where it was. I know the names. I just couldn't pinpoint it on a map at the moment. Kim is Anaheim. In Anaheim, it's a new KB Homes construction, but it's next to a gas station. You're talking about the house that was $40,000. Good thing or bad thing? Up to you. It's probably an infill project of some sort. If you back to the gas station, maybe a bigger issue than not. Homes like that may or may not have resale issues. It's all depends on the market. Too hard to tell you without knowing exact location and everything. Just kind of do What's right for you? And yeah.
I would say it's less of an issue than it used to be for us here in Orange County. Like Orange County used to be like wide open. So people were like, oh, I don't like that. I want to be away from it. As it's got built out and we have more and more infill stuff. There's one over here in Fountain Valley they built 6 or 7 years ago that like almost everyone has a view of the gas station from their upstairs windows. Still a nice community. They still get nice prices for it. So given their choice, most buyers don't want that. But when there's a small discount or there's a limit in inventory, I don't think it's something that's going to keep people from buying either.
Good stuff. Patrick is asking, any promotions on new IPAs? We do not have a promotion on any IPAs. We'll take one. We'll drink them on the air. At the moment,
we will drink anything, any alcohol you guys send in. We will do live and give more accurate answers.
This is all of the stuff on this list. I mean, these are all the treats that we have here. And I mean, I don't know that we can eat all of this. I mean, this is crazy talk. But I got a chocolate bar, Josh. I mean, I figure you can't go wrong with chocolate. Dorina Kex. It's a milk chocolate with biscuits, whatever that means. What is milk? Like, what are these Europeans eating, man? It's got biscuits in it.
Biscuits.
Like, what is that? So I'm going to try this thing on the air. You can get a question. I'm going to eat some chocolate.
Okay. Here. No, we've got a couple of good questions. And Kim actually followed up. She wanted to know, she means as far as accidents or fires. All I know is, have I seen gas station accidents and fires on the television news? Yes, I have. Have I ever seen one live? No, I haven't. So I wouldn't be too worried or concerned about that. So do you want me to wait till you're done?
Croatians might be onto something, bro.
I was going to say, did you want me to wait till you're done chewing before we ask for feedback?
That's pretty good stuff. It's kind of like a Nestle's is a Crunch bar. A Nestle Crunch,
yeah,
it would be comparable. I think the chocolate's probably better than the other chocolate. That's pretty good. I could eat that. All right. Well, guys, that was fun. I'm going to go eat the rest of these.
He'll be eating. We've got some mortgage questions. I'll answer. You sample something else. You have one. Go to another sample there.
I got a whole box, bro.
What else do you got? That's too big. You're not going to get all the way through.
No, these are like wafers. These are like Euro waffle.
You can have one of the waffles, and then your kids will kill them.
A Euro waffle.
So Claudia Navarro wants to know: is it worth it to buy down the mortgage rate to 4.3% if the rates may go down next year? Difficult question to answer without knowing the cost. Are we talking 1 point? Are we talking 3 points? And it also comes down to, do you need it to qualify? If you don't, like I said, right now it can make sense to pay a point, maybe even a little bit more, depending on what that rate stack looks like. But most people aren't aware, a rate sheet on any given day, we can offer anywhere from 3.75 to 7.25. You want to see the differences in all those and find the sweet spots for you. For the most part, I do believe that in the next 1 to 3 years, once this inflation stuff passes over, we will get a window of being able to refinance in the low 4s, high 3s without having to pay it. So I would lean towards not, but I would want to see the numbers, and paying a point probably is in your best interest at this point in time. How was the waffle?
The Euro waffle was dry. 2 silky layers of chocolate cream filling with 1 luxurious layer of hazelnut cream. Yeah, I didn't get that. I mean, it wasn't awful, but I wouldn't go back for another bite. How's that?
I gotcha.
What do you got?
I
got less viewers, that's for sure. People are out of here. But
you ran them all off. That's why I'm trying to answer questions. I'm not as adventurous as you are. I'm concerned that someone sent you a box of poison.
Well, if they did, we'll find out, won't we? It'd be good. Hey, it'd be the last filming. This would be fantastic.
Let's say this: if we come back next week and Jeb is still alive, I will have my snacky or smoky, my Prima Classic, which looks like some pretzel sticks, and then I have a Euro waffle block, and it literally says block. I like that, so I'm going to keep these here, Jeb, and you're the guinea pig. I want to make sure you live, and we'll extend the promotion to next week.
So I got an Animal Kingdom. It's a chocolate mascot on a stick, sculptured in the shape and appearance of an animal. There are 5 possible mascots. So I was wondering why I got a card in there of a bear. And you don't know which one you're going to get until you open the pack. So I got the bear, man. So is that a sign that we're into a bearish market?
That's a negative sign. I don't like it.
Oof, I don't know. That's not good. But this one's milk chocolate on a stick, supposedly. I don't know what that means. Anyhow,
right.
are people still here?
More people came back. We were down to
I'm actually
168.
eating.
It's up to 174.
So
The
if anybody
promotion.
doesn't know what's going on here, I was given a box of chocolates or a box of treats by
Life is like a box of treats.
trytreats.com. There's a link in the description where I got treats from Serbia and Croatia. Looks beautiful. Absolutely beautiful out there.
It is beautiful.
This is chocolate. You know, tastes just like chocolate.
Anya would like for you to send some of them to her house. She says they look lovely. Yep.
Listen, Anya, send me an address. Message me. Email me your address. I'll send this entire box over there.
So we do have Don Draper actually back with a good question here. He heard us say that an FHA for lower credit scores has a lower monthly payment than a conventional. The interest rate is always going to be lower on an FHA than a conventional, and historically that was not the case. Prior to the crash, investors in mortgage bonds looked and said, FHA loans and VA loans default at a higher rate than conventional loans. Will pay more for conventional loans, so they'll have a lower rate. After the meltdown, people realized these are the only loans, FHA, VA, USDA, that have an actual U.S. government guarantee. So they'll pay more for them. So the rate is lower. And then for people with lower credit scores, the mortgage insurance can be lower. If you have a 650 credit score and you try to do a 3% down conventional loan, you're going to have exorbitant mortgage insurance and a higher rate. So it works to the flip side. If you two people buying together both have an 800 credit score, they're going to have a really low mortgage insurance rate on the conventional loan and will probably lead to a lower payment despite the higher interest rate. So it all relates to how the interrelation there of interest rates and mortgage insurance rates.
All right, this is the last one I'm doing because I'm like chocolated out over here.
You've had
this
everything.
This is Bananico. Bananico, and this. Hold on, watch the bottom of the screen.
We need to go to your OnlyFans channel before you can eat that on camera, Jeb.
Oh, that's hilarious. So what is this thing? It is a banana-shaped chocolate candy
yes,
bar
it is, Jeb.
with a banana-flavored foam center. Distinctive banana shape and flavor. It's a staple candy bar in Serbia and Croatia.
Jeb's acting like he doesn't know what this is. He knows good and well what that is with the foam center.
Looks like a turd.
Woo! Kim likes your face with the banana turd.
This thing is terrible, bro. It tastes like it's got the consistency of those bunnies you eat on Easter, like the little what are those things called?
Peeps.
Peeps.
Peeps are amazing.
That's the center of it. That's what the center, like the consistency of, but it is super strong banana. Like, yeah, no, can't do that one. Yeah, I'm not going back there. All right, guys, I'm back. We're doing questions now. Can't do that anymore. Woo! It looks like a duty, he said. It does, and it tasted like one too.
Yes, with a foamy center.
Oh boy. Okay, here we go. Juan. How many years does it take for a mortgage protection insurance to drop off after purchasing a home? So talking about mortgage insurance. You need to reach 22% equity in that property with a conventional loan for it to quote unquote fall off. If you feel like you have the equity in the property, you can always reach out to the lender, have a conversation, and see if there's a way to reduce it. If you do have the equity in there, you can always refinance out of the loan, get into another loan, drop the MIP. Josh, anything else you want to add on that? Man, this is really not good.
No, that's you essentially nailed it. So the more you put down, the sooner you can reach that 22%. If you put 10% down, you're going to get to 22% much faster than if you put 3% down. With the minimum down, it's going to be more than 10 years before it drops off automatically. With the rapid appreciation of the last couple of years, if you think you're there and you've had the mortgage insurance for at least 2 years, you can reach out to your servicer and talk about the process for getting an appraisal and having it removed before that.
Good stuff. Now, so I said I was done because I don't want to do this again next week. I'm going to eat the Eugenia original biscuita.
Didn't you just say you were done? You're not eating anything more,
No,
and then now
I'm
you're
doing
back
it.
and you're eating
I got to
more?
get the taste out of my mouth, dude. So I got to go. I got to go a different one.
Well, hey, let me throw another comment up here after
So
you
this
get
is
to
a
the
delicious
Eugenia.
biscuit filled with chocolate cream. What is the deal with cream and biscuits over there?
They love biscuits and
Anyway,
cream.
all right. Oh,
So
this looks like a. Go ahead.
Barry Alley follows up with insurance companies don't typically like residential properties located next to commercial properties in Oregon. That's probably pretty consistent around the country. And it brought to mind, I have a client in Carson who owns a home that the only way we were able to refinance it was with an FHA loan. And it turned out that he was within, I believe the number is 100 yards of a gasoline or oil storage tank. You're ineligible for FHA financing. This was noted in the appraisal. The lender didn't catch it and ended up having to refinance that person into a conventional loan at a heavily discounted rate at a large cost to them. So going back to that gasoline station question, if you're too close to it, it can eliminate FHA financing for future buyers, and that could have some sort of impact in addition on the future value, in addition to the insurance question that we had there.
So as you guys know, well, you might not. YouTube is actually about a 10-second delay in when we film. So I'm looking at one screen here and I see like current whatever. And then I can see on the other screen here what happened like 10 seconds ago. So while Josh was talking, I watched myself eat that last thing. And my face said exactly what I was thinking. And that's that it wasn't very good. I've determined I'm not a fan of biscuits filled with cream of any sort. This one was a delicious biscuit filled with chocolate cream, making it a perfect cookie. That was not a perfect cookie.
Is this is
Roger,
did Kim nail it?
did she? I don't know what she say.
Look on
Like,
your
is that
screen.
me
That
barfing? No, it's
yes.
not that bad. But I was hoping. I don't know if you ever remember having these. Like there was the Keebler elves, right? They had that little, the Keebler elves had a cookie that was kind of like the Keebler elf cookie, and then inside of it was a cream. Those were delicious. I used to eat those things up as a kid. I had really high expectations that this was going to be that. It was not. So the only thing I have left are chews over here, and I'm not going to chew on the air. So we're done with that. But foamed center practitioner said foamed center. Yes, it was more of a foamy center. It was not good. Roger's probably not going to ask me to do any more promotions of his treats. But if you're from Serbia or Croatia, you probably like this sort of thing. So, it's all what you grew up on, right? Nostalgia, if you will. My kids are going to be eating this now, and I'll film them when I get home, and you guys can watch.
That'll be way more fun. So
Oh
definitely
yeah,
film the boys and
I
let's
won't
show
tell
that
them.
this
I won't
next
tell
week.
them what I think of it. Let's see here. Chris Diaz, besides make more money, what's your take on the affordability of SoCal properties? It's tough. I mean, I don't know that I know your question, what you mean by your question exactly, but affordability is a problem. I don't know that it's going to get much better in either direction. I think what happens is over time, values probably move sideways. Wages make some progress and catch up some. Inflation comes down, gives people a little bit more buying power with that discretionary income, and eventually prices move up. In the short run, I think you got more sideways movement than anything else. Josh, anything you want to add on that?
No, it's just the affordability is rough. There's no two ways around it. I talk to people all day, every day who make good money, who have good credit, and can't afford where their area is. For some people, they qualify for 6, and it takes 800. Some people qualify for 8. It's $1,000,001, and that's a tough conversation to have. And it's the only thing that's going to fix that is interest rates going back down, or incomes increasing over time. So it's an unfortunate reality of Southern California, the Bay Area, New York City, Connecticut, Boston, the trophy areas of Florida. It's sort of a reality of where we're at. We forgot Austin, Boise, all of these markets that have kind of gotten crazy, and affordability is rough.
No, it is. Yeah. But again, that doesn't necessarily mean things have to drop substantially. So let's see. What do we got here? Our I can't even read at the moment.
The one you have
Archibald?
on. Oh yeah, you've already answered
That
2 of
was,
his questions tonight.
I can't. Well, dude, I wasn't listening. I was like, my eyes, like
I
Archie Bell.
believe you've been poisoned,
Apple
Jeb.
is
This is
moving
this is
to
the poison kicking
San
in from
Diego.
your
By
treat.
now, if you could turn, I think like the light caught my eye, dude. And I was like blinded. Can it? By now, if you can, it will turn to Silicon Valley 2.0. Yeah. So Apple is doing a facility down in San Diego area, and that may continue to push property values up. I mean, anytime you have big employers coming to an area, job growth, increased stability in jobs, that's a good thing for markets around it. Unless you don't own property now, right? It could increase the value of those homes over time. So anyway, let's see. Josh, we got 23 likes so far. Been on almost 2 hours. Asking, before you guys exit tonight, hit the thumbs up if you don't mind. Feel free to subscribe to the channel to stay updated on Serbia and Croatian snacks. Just kidding. Won't do that again. Just stay updated on the market. And we appreciate you being here. This will be a podcast, as I mentioned, on Friday on The Educated Homebuyer. We'll take it and put it on there so you can listen to the entire thing at your leisure.
Including Jeb eating snacks. That'll come across great in the podcast.
They're not even going to know what we're eating, but if you're listening there, you just come back to the video and watch. See, it's kind of a, two-hand thing. If you need a referral to a lender, mortgage professional, there's a link scrolling at the bottom. Go to that. Josh, parting words tonight.
Just good to be back. I missed you guys the last couple of weeks. Jeb was off in North Carolina before he got to his phone centers, and then I was off last week. So good to be back answering questions. Hopefully it was helpful for you guys.
Yeah, no, we appreciate you being here. Anything, question wise, content wise, you want us to cover, leave it below. I mean, we go back and look at some of the stuff, and, try to get ideas, what people are into, what you're not into, what you want to see, what you don't want to see. Hey, if you like treats and you want to see more of that, Josh has some treats over there he could eat next week. I'm just saying. His reaction will probably be better than mine. But anyhow, we appreciate you being here, guys. Till next week. Adios.